Basel II Advanced Measurement Approaches, AMA, Operational Risk, a simple Excel Monte Carlo model. The Basel II Accord specifies three approaches for calculating the buffer capital to protect the bank against operational risk. 1. The basic indicator approach. 2. The standardized approach, and 3. The advanced measurement approaches. The basic indicator and the standardized approaches are straightforward and easy to model. Both are based on gross income and fixed percentages for the financial institution as a whole or for its business lines. We have published a brief video that explains these approaches in more detail and shows how to calculate the capital charges in Excel. For the advanced measurement approaches, things are not so simple. For one, the calculations are complex and the demands on management and data collection are considerable. Moreover, the approach calls for interaction with the regulator to get the approach approved. This makes that the advanced measurement approaches are, in practice, only used by the largest and most advanced financial institutions. Although implementing an advanced measurement approach is taxing, there are advantages. A refined assessment of the operational risks may lead to lower capital charges. Using this approach also comes with some prestige, as only the more sophisticated banks can meet the requirements. Furthermore, regulators tend to push the larger internationally operating banks toward the advanced measurement approach. Within the scope of this video, it is impossible to cover all the aspects of the advanced measurement approaches. Moreover, we should keep in mind that the approach is bespoke for every bank. The essence is that the financial institution itself proposes and defines the approach. The supervisor is to determine whether the approach is credible and appropriate. The Basel Accord does not specify a calculation method nor the type of probability distribution to use to simulate the risk. However, it does stipulate that the model should cater for tail risks and provide for a risk coverage up to the 99.9 percentile. The risks to consider should be mapped to the Annexes 8 and 9 of the Basel II Treaty. Annex 8 defines at the first level the business lines. 1. Corporate finance. 2. Trading and sales. 3. Retail banking. 4. Commercial banking. 5. Payment and settlement. 6. Agency services. 7. Asset management. 8. Retail brokerage. Note that these are the same business lines as used in the standardized approach. The first level of the loss event classification in Annex 9 lists 1. Internal fraud. 2. External fraud. 3. Employment practices and workplace safety. 4. Clients, products and business practices. 5. Damage to physical assets. 6. Business disruption and system failures, and 7. Execution, delivery and process management. The bank should classify the operational risks it identifies in a matrix with on one axis the business lines and on the other axis the loss events listed above. This results in 8 times 7 equals 56 potential risk areas with one or more risks. For each of these risks we determine their expected frequency and their expected impact or severity. To better understand the advanced measurement approach, we would like to build an Excel model that shows the essence of this method. Given the complexity of the advanced approach, we limit ourselves to a simplified model limited to 5 risks: A, B, C, D and E. A Monte Carlo simulation is a great way to calculate the operational risk. We will use the Poisson distribution to model the event frequency and the Lognormal distribution for the impact. The example spreadsheet can be downloaded. The Poisson distribution is defined by just one parameter, the rate or frequency. If we expect 3 clients in our shop per hour, then the rate is 3. The minimum is 0 customers and there is no maximum. However, we see that the probability of receiving more than 7 clients is small. We also notice that the values are integers. The rate, though, does not have to be an integer. If an event occurs on average once every 10 years, then the rate is 0.1. Although Excel does have a Poisson function, it does not provide an inverse Poisson distribution. For our simulation we need an inverse function since we would like to generate random values for the loss event frequencies. An elegant way to circumvent this problem is to use the inverse binomial function. We have dedicated a separate video to this technique. For the first input parameter, the number of trials, we take a very high number. The second parameter, we define as the loss frequency divided by the number of trials. If we have defined a sufficiently high number of trials, this p-value is close to 0. The third input parameter is the rand function that generates values between 0 and 1. Thus, we have built a simulator that spits out loss events following a Poisson distribution. Given the low loss frequencies, most trials will not generate a loss. However, we see that loss events do occur, and sometimes even more than once a year. We model the severity of a loss event with a log-normal distribution. This distribution is skewed to the right and allows for tail events far from the distribution center. The distribution has a floor on the left, that usually equals 0. The log-normal distribution is defined by a mean and standard deviation. But, this mean is not the mean of the observed events, but the mean of the natural logs. The same goes for the standard deviation. It is easiest if we work with real data. Say we have collected loss data for the risks A, B, C, D and E. The first step is to take the natural log of all values using the Excel ln function. Using the Excel functions for average and standard deviation, we get to the correct input parameters for our log-normal distributions. Since we are looking for a simulator that cranks out log-normally distributed losses, we need the inverse function. Next to the average and standard deviation, we use the rand function to generate random data between 0 and 1. Now we are almost there. We can simulate our loss events as well as the financial impact in case such an event occurs. In Excel we can create 10,000 trials for the risks, A, through E. With the sum product function we can easily multiply the number of events with the impact, and sum the results. With our list of 10,000 simulated annual total operational losses, we can calculate the capital buffer. The Basel II rules require a capital coverage of 99.9% of these simulated losses. We assign the name, losses, to the simulated loss data. Using the Excel percentile function, we can calculate the loss to the 99.9 percentile. We note that this approach resembles the value at risk approach, which is often used to gauge market risk under the Basel Accords. Now we have our answer. With a capital buffer of 9.98, our financial institution has enough capital to cover events in 99.9% of the cases. If our bank were to live 1,000 years, the institution would be covered in 999 years, and only in 1 year the 9.98 buffer would not be sufficient. In this video we explained the basics of the advanced measurement approaches for operational risk under Basel II. We built a simulator in Excel that generates loss events using an inverse binomial distribution. The data created are distributed according to a Poisson distribution. We used an inverse log-normal distribution to produce the loss severities. We derived the inputs for the distribution definition from real loss impact data and transformed them using the natural log in Excel. This Monte Carlo model simulated losses for 10,000 virtual years in the bank's life. We took the value at the 99.9th percentile to find the capital buffer required by Basel II for operational risk. We managed to come up with a working model that in a simplified format has the elements to calculate operation risk buffers under the advanced measurement approaches. Good luck.